As a small business owner, maximizing your tax deductions is crucial. This video is for anyone who earns self-employment income, such as 1099 contractors, sole proprietors, and LLCs. Whether you're just starting out or looking for ways to optimize your tax strategy, understanding these deductions can help you save money and grow your business. Hi everyone, if you're new here, I'm Deandre Jones, and today we're going to cover the top 5 write-offs for LLCs. So let's jump in. Number 1 is startup and organizational costs. When starting your LLC or business, the IRS states that owners should treat all eligible costs incurred before beginning to operate the business as capital expenditures that are part of their basis in the business. This simply means that when you're starting a business, any money you spend before you actually start operating should be seen as an investment in the business itself. These costs could be things such as building your website, trainings for your profession, or licenses, and so on. The IRS allows you to deduct up to $5,000 in startup and organizational costs in the first year. Any remaining costs can be amortized over the next 180 months or 15 years. This deduction can help offset the initial expenses of setting up your business. Number 2, marketing and advertising. In order to run a business, we need customers. They are the heartbeat that keeps our businesses up and running. So marketing and advertising are generally a huge expense for most businesses, and they help us keep consistent business. To our benefit, the costs related to marketing and advertising your LLC are fully deductible, which means your advertising and marketing expenses don't have to be amortized or depreciated like vehicle or equipment expenses. Instead, the full amount you spend is deductible in the year you spend it. This includes expenses for online ads, print ads, website development, and any other promotional activities. These deductions can help you attract more customers and grow your business. Number 3 is the home office deduction. Many business owners operate out of their home or conduct certain aspects of their business from their home. If you use part of your home for business, you may be able to deduct expenses for the business use of your home. The home office deduction is available for homeowners and renters and applies to all types of homes. Another great thing is that the IRS allows you to deduct expenses for a separate freestanding structure as well for the home office deduction, such as a studio, garage, or barn, if you use it exclusively and regularly for your business. Let's get a better understanding of the 2 main requirements for your home to qualify for this deduction, which are regular and exclusive use and principal place of your business. First, you must regularly use part of your home exclusively for conducting business. For example, if you use an extra room to exclusively run your business, you can take a home office deduction for that extra room. Next, you must show that you use your home as your principal place of business. If you conduct business at a location outside of your home, but also use your home substantially and regularly to conduct business, you may qualify for a home office deduction. For example, let's say you have in-person meetings with patients, clients, or customers in your home in the normal course of your business. Even though you also carry on business at another location, you can deduct your expenses for the part of your home used exclusively and regularly for business. Here's how you use the home office deduction. Number 1, you need to calculate your home office percentage. You're going to measure the square footage of your home office, divide the home office's square footage by the total square footage of your home. This percentage is your home office percentage. Number 2 is to deduct your expenses. With the home office percentage you now have, you can deduct a portion of expenses like mortgage interest, property taxes, utilities, and maintenance costs. These deductions are based on the percentage of your home used for business. By following these steps, you can take advantage of the home office deduction to lower your taxable income. Number 4 gets a lot of buzz: vehicle deductions. If you use your vehicle for business purposes, you can deduct the expenses related to its use. There are several options we have when taking a vehicle deduction. First is the standard mileage. If you travel to meet clients or travel to deliver products for your company, the standard mileage deduction can be one of your best tax deductions, especially for people such as Uber drivers, Lyft drivers, and truck drivers. The standard mileage rate is 67 cents in 2024. Just take a second to calculate 67 cents times every mile you drive. It adds up pretty quickly. The most important thing here is remembering to track every single mile. This can be done efficiently now with apps such as MileIQ, Zoohoo, Expense, and QuickBooks. The second way to take a vehicle deduction is using actual expense. To use the actual expense method, you must determine what it actually costs to operate the car. This includes gas, oil changes, repairs, tires, insurance, registration fees, licenses, and depreciation or lease payments attributable to the portion of the total miles driven that are business miles. So if the car is used exclusively for business use, you can deduct 100% of these expenses. And the last method is Code Section 179. That allows you to deduct the full purchase price of qualifying equipment and or vehicle purchased or financed during the tax year. This deduction is particularly beneficial for small businesses as it can provide a significant tax savings. The weight limit for vehicles eligible for the Section 179 deduction is 6,000 pounds or more. And number 5, self-employment tax. I know what you're thinking, how is self-employment tax a write-off? Well, hear me out. As a self-employed individual, you're responsible for paying both the employee and employer portions of Social Security and Medicare taxes, also known as self-employment tax. This is a huge expense. 15.3% of 100% of the income you generate in your business, to be exact. Which brings me to the solution. Elect your LLC to be taxed as an S Corp. This tax strategy saves so many clients tons of money. A major advantage of S Corporation taxation is the ability to minimize self-employment taxes and taking a payroll tax deduction as a shareholder. Here's a simplified example to illustrate how this works. Suppose you have a single member LLC taxed as a disregarded entity with $150,000 of profit. You'll pay self-employment taxes of 15.3% on this entire amount in addition to income taxes. Now suppose you elect S Corporation taxation and pay yourself a reasonable salary of $85,000, leaving you with the business profit of $65,000. As an S Corporation, you'll pay Medicare and Social Security taxes on your $85,000 salary, but not on the additional $65,000 in business profit, saving you almost $10,000. Taking advantage of these tax write-offs can help you reduce your tax liability and keep more money in your pocket as a small business owner. If you enjoyed this video, be sure to give it a thumbs up and subscribe so I can continue making more tax and financial education content for you guys. Thanks for watching, and I'll see you in the next video.